Thank you. I'll try to keep the comments as brief as possible. I think the regional economic outlook, of course, always well anticipated, but the danger that we face right now is with events overtaking us, that maybe the world starts to look very different. In Africa itself, there's a feeling that Africa has done well in growth terms, a decade of growth having averaged higher than the global average, but increasingly discussion about how meaningful that growth is, how much of a structural transformation is indeed taking place in the region. And I think some of the findings of this report will be very important as a contribution to that debate. On the one hand, we know that to be able to get those developmental gains, the growth needs to be sustained over time. And I think the key question that's likely to be occupying everyone is just how much of a threat does Africa face as a result of the euro area crisis? And this is where I think that at the current moment we do seem to be hurtling towards perhaps a more severe crisis. A lot of the analysis that was included in the Regional Economic Outlook looks at the impact in terms of the direct consequences of a slowdown, potential slowdown in Europe, what that might mean for an Africa that has seen a diversification of its trading partners to some extent. But the key point, as was raised by Isabella as well, is that if you look at Africa's trade growth with other new emerging partners, those emerging partners themselves are very much dependent on trade with the euro area. It's not as though anywhere globally is going to be immune, and therefore I think the risk may well be that we do see more severe downside outcomes in the sub-Saharan African context. The point that the Regional Economic Outlook makes very well is in terms of the external buffers and just how much those have been eroded since the last crisis. Now, part of the reason we believe sub-Saharan African economies were able to grow that much faster, even given the headwinds associated with the last global economic crisis, had a lot to do with the growth momentum of those economies going into the crisis. So they had a period of elevated growth. They were able to build up more savings going into that crisis, but it was the fact that they had just come out of that period of good growth that helped to carry things along for many of those economies. So for a lot of the resource countries that might have been hit harder, the fact that we still saw very buoyant growth in the non-resource part of their economies, we think, had a substantial impact on the overall outcome. And the question we would ask now is, to what extent can we still rely on the same factors carrying African growth through? A lot of countries, especially those that engaged in some form of fiscal stimulus, now face the challenge of having to roll back that stimulus. It's been difficult. It didn't happen necessarily when growth rates were still good. Very difficult to imagine that it will be easy to achieve if we should see a renewed downturn in the global economy, new downside pressures on African growth. A few comments on how the financial crisis might impact Africa. And this is where I differ slightly with a lot of the analysis that has been done by the fund, by the World Bank, in terms of the financial crisis the last time round and the impact on African economies. I think there tends to be a lot of commentary about how African financial institutions, first of all, look at financial intermediation in Africa and the role that they play in terms of overall GDP growth. We do need to qualify it in those terms. We're not talking about more developed economies with deeper financial systems where the feed-through is going to be much more immediate. There is a lag at work, and I think we need to do a lot more to try to understand that. The second point that a lot of analysis relies on is that African institutions are much more dependent on domestic liabilities to fund themselves than they are in wholesale funding. Therefore, that lends them some degree of immunity. While that is true, I would argue that offsetting that, there is a very real feedback loop from the real economy and the slowdown that we might see in real economies back into what financial institutions are doing. I don't think it necessarily stems from the fact that European banks are very active in Africa. I don't think we should look equally at all European banks in Africa. Some will have substantial exposure to the euro area periphery. Others will have minimal exposure to the euro area periphery. I think the big influence on what banks in Africa are willing to do has to do with their assessment of the real economy prospects in the economies in which they operate. And that necessarily is going to be a function of the global economy. It will never be seen in isolation. African countries haven't seen sufficient diversification of their export bases or their revenue bases, and that's the essential problem. Vulnerable countries become even more vulnerable in a crisis, and it's very difficult to see what kind of buffers can be put in place soon enough to try to offset the impact of that. If we just look at the impact of the banking sector of the last crisis, I think there's a tendency to look at Nigeria's experience and say that was the only country in Africa that saw a real crisis in its banking sector. And as was rightly pointed out, a lot of the causes of that were homegrown in terms of the governance situation with the financial sector there. But if we look at what actually happened to loan growth across a number of different African countries, look at South Africa, where the banks were in good shape pre-crisis, the banks are in relatively good shape post-crisis. Yes, yet there has been this slowdown in private sector credit extension, in private investment, that is very difficult to explain in terms of the usual influences on banking sector activity alone. In other countries, Ghana and Angola spring to mind. The arrears that were built up by governments there had a meaningful impact on non-performing loans in the banking sectors, and therefore, understandably, a meaningful impact in terms of the extension of new credit. For the mining economies, countries like Botswana and Zambia, what was happening in the real economy, what happened with that initial commodity price shock, an all-important influence on credit creation, which followed. Of course, one could argue that maybe the impact of the global crisis in terms of the commodity price shock was relatively short-lived. As severe as it was, the bounce back was quick, and we should be asking whether the same conditions will necessarily apply if we should see a renewed global economic downturn. Finally, perhaps just a few words on some of the conclusions in the chapter about resource-rich economies. And I think it goes back to the necessity of looking very clearly at what sort of structural transformation we have seen at work in African economies. I'm afraid I probably don't share the optimism that there hasn't been sufficient evidence to suggest that the resource curse might have been as important as we once thought it was. I think we need to look very carefully at whether liquidity has perhaps clouded some of the judgment of what has or has not been taking place in those economies. We could take Nigeria as an example, a decade of very good rates of growth, most of that coming from the non-oil economy, the oil economy actually underperforming. But if you're looking at poverty indicators on a countrywide basis, you're not necessarily seeing the evidence of improvement that you see in certain non-resource-rich countries in Africa. Now, of course, very difficult to generalize on that basis, and we could probably spend a long time discussing this point alone. But I think the danger is that a decade of good headline rates of growth, a decade of sound commodity prices, perhaps for most of that time we have been in a commodity super cycle, may mask some very real problems in terms of human development indicators and the changes that are not happening sufficiently rapidly to suggest that growth can be sustained despite the commodity cycle, whatever happens with the commodity cycle, for a long enough period of time.